all starts with credit, right? The two things that make this engine run is credit and income, right? So I'm going to assume that everybody else here has good credit. Everybody here has good credit too, but everybody has good credit because you're all bondable, right? You have to be for your industry. But even so, there are some people who have good credit, but because they don't understand how it works, they might make a critical error that could damage their credit. So just to avoid all that, we're going to go through how credit scores are tabulated and what lenders look for. So that's the general overview, all the topics we'll be covering today. So I think we all intuitively know that if we start missing payments, we're going to damage our credit, right? But what a lot of people don't know is that everything stays on your credit report for 6 years. And it's tracked by what's called the date of last activity. Usually on a credit report, you'll see DLA. That's what they track. After 72 months, it disappears, whether it's good or it's bad, right? The other thing that impacts your credit, those first two are probably the biggest things, the balance to limit ratio. So let's say that you have a $10,000 credit card, a $10,000 limit, and your balance is like $9,900. It's going to impact your credit severely. Right? You could drop your score by a good 90 points, 100 points, right? Whereas if you have a $10,000 limit and you're only carrying a balance of maybe $100, your score is going to be much higher. Now that's actually the quickest way to bring somebody's credit score up. If they're carrying a high balance and we pay off that balance, within less than 30 days, their score will go up, right? The age of the trade line. So on your credit report, each item that reports, so whether it's a loan, it's a line of credit, those are all trade lines. So in the mortgage world, though, we only really look at loans, lines of credit, credit cards, right? The stuff you get from the banks typically. We don't look at cell phones or some of the other things on there. I'll actually get into some credit reports. I'll show you what they look like. There are two versions of an Equifax report. There's the consumer version that you'll see. It's more colorful. The layout's different. And then there's the lender version that we see. We're going to look at the lender version, and I'll explain some of the terms. So how many active accounts that you have. This doesn't so much impact the score as it does the lender's perception of you. So let's say that you have like 10 credit cards, right? Even though you might have good credit because they're zeroed out, the lender might look at it and say, well, yeah, he's got good credit now. He's not maxed out. But what if he were to run into trouble? He'd max up all these credit cards and not be able to afford it, right? So again, it doesn't impact the score so much, but the lender's perception. You don't want to have too many active trade lines. The size of the account. So to qualify for a mortgage, the general rule of thumb is you want to have at least 2 trade lines of at least $2,000 each, reporting for at least 2 years, right? So a couple credit cards of $500 limits is not going to cut it, right? They want to see that you can carry major balances over a long period of time, right? So they want to see at least 2 years. The maximum they track is 6. So if you have a few trade lines that are all 6 years old and you've been carrying them well, you have good credit. The number and frequency of inquiries. So an inquiry is each time somebody checks your credit, right? So I always tell my clients, do not fill out a credit application unless it's absolutely necessary, because each time you do, it drops your score by about 4 or 5 points. So 1 is not a big deal, but I've seen credit reports, and I'll show them to you in a minute, where the client has gone all over town and you're seeing 10, 20 inquiries, and it drops their score, and each one stays on for 3 years, right? And a lender looking at it will say, well, this person's just a credit seeker. They're clearly in trouble. They're going all over town looking for credit. So you don't want to have too many inquiries on your credit report.
Excuse me.
Yep.
Can you talk about hard hits versus soft hits?
Sure. So a hard hit is exactly that. When somebody pulls your credit, that you filled out a credit application, that's a hard hit. It shows on your report for 3 years. A soft inquiry is you already have an existing lender, and maybe your credit card company wants to know if you want to increase your limit or not. They'll do a soft inquiry. It won't show to any other lender out there. Only you'll see it when you pull your credit. Another soft hit is when you pull your own credit, right? It doesn't ding your score at all. So soft hits don't ding your score. Hard hits do. So the question was, when cell phone companies check your credit, so you go into TELUS and you fill out a credit application for a cell phone, that's going to be a hard hit. It's going to stay on your credit report for 3 years. It's going to drop the score by about 4 or 5 points. Length of employment and addresses. So again, this one doesn't affect the score, but it affects the lender's perception of you. If you're always switching jobs and moving around every 6 months, you look like somebody who's unstable, right? So the chances of somebody giving you $1 million mortgage, if you're always switching jobs every 6 months, it's a little bit slim. Make sense? So just some tricks to boost your credit score. One is to simply increase your balances. So every so often, if you've been maintaining your credit well, your credit card issuer will offer to raise your limit, or if you have a line of credit, they'll offer to raise your limit. That's an overnight way to increase your score. Because again, the balance to limit ratio, right? If you had say a 5,000 balance on a 10,000 limit, and they raise it to $20,000 limit, now it looks like you're only carrying 25%. You are only carrying 25%. So overnight, your score goes up, right? The co-account holder trick. So a lot of lenders are ruling this out, but the way that it works essentially is, let's say that your spouse has a credit card, right? You can be added to that account. Now that's different from being a card holder, because a card holder doesn't show up on the account and it wouldn't show on your bureau. But if you're actually added to the account itself, your name shows up on the account and the credit history now shows up on your credit report, right? So I'll speak for on this one. When I was younger and I wanted to buy a house, but my credit was weak, my mother at the time had a Leon's card. And at the time, the lender behind the Leon's card was HSBC. So I went to the Leon store and I filled out a credit application along with my mother. She added me to her HSBC account. And overnight, the 6-year history that she had showed up on my credit report and my score went up. Now, the reason why a lot of lenders have been phasing that out is because people were abusing it. They would advertise their credit cards on Kijiji and Craigslist. Here's a $1,500 credit card. Pay me $3,000. You'll have credit. You know what I mean? Like, so it's abuse of the system, and so it's getting harder and harder to find lenders who will allow that, right? But it's an overnight way to boost your score. Pay down your balance before the reporting date, then draw the same funds to pay. So it's just essentially revolving money. So let's assume then that you have 2 credit cards of $5,000 limits that are maxed out. You have a line of credit with a $10,000 limit owing $5,000, right? So you owe $15,000 and you only have $5,000 to pay it. Each creditor reports to Equifax on a different day of the month. So they could report on the 5th, the 12th, the 20th. You got to call and check and see which date each creditor reports, right? So starting on the 1st of the month then, with your $5,000, you'll pay off, let's say, the line of credit. Paid off, it's a $10,000 limit, you're now owing 0, right? Moving on to the first credit card, you have $10,000 in your line of credit, you use part of that to pay off the credit card, right? Say it reports on the 12th, so that's paid off. You use the remaining $5,000 from your line of credit to pay off the second credit card, so that's zeroed out. Now, by the end of the month, it's going to look like you paid off everything. You still owe $10,000 in your line of credit, but when I check your credit, it's going to say everything's zeroed out. Make sense? Now, it's not fraud because this happens before you even fill out a mortgage application, right? It's only after you fill out the mortgage application and you're approved. If the lender says that you have to pay off your debts in order to close your house, and you do this, that would be fraud. You guys follow what I'm saying? So using low interest, like the mortgage, your mortgage is the lowest interest money you'll ever get, to pay off your high interest debt, right? So a lot of people, if they have equity in their homes, will use that to pay off their credit cards, right? You still owe the same amount of money, but the interest rate is much lower and the payments are lower, you can pay it off faster, right? Less interest, you pay it off faster. So just a few ways then to essentially boost your credit score and manage your debt better. Make sense? So I'm going to switch over to actual credit reports. I'm going to show you 2 bad ones, and I'm going to go through why exactly they're bad, and then we'll get into 2 good credit reports. So I blacked out all the critical information. You're not going to see the person's name. I'm sure they don't want their name shown on this credit report. As you can see here, the score, 516. So credit reports theoretically range from 300 to 900, right? I think the lowest I've seen is about 450. And for the first time ever, last week I saw 900. Some of the reasons why, you're going to see a lot of inquiries. Remember I said each inquiry drops your score by, 4 or 5 points, right? So this is an older credit report. I pulled it in 2016, right? So the inquiries start right there. And so that's like 16 into 15. That's a lot of inquiries. Like, it's just ridiculous. And then below that, you'll see things like judgments. So she defaulted on a consumer proposal. Does everybody know what a consumer proposal is? Okay. So you have bankruptcies and you have consumer proposals, right? These are for people who can't afford to pay off their debts. They're in a bad situation where, say, they owe $100,000. There's no way to pay it off, right? Most people in that situation should file for bankruptcy. But a lot of the bankruptcy trustees, what they're doing is they're using the word bankruptcy, which is a red flag word, to scare people towards what's called a consumer proposal. The consumer proposal is essentially they make you pay a portion of the money that's owed. Say out of the $100,000, you'll have to pay $50,000, right? And they give you maybe 4 years to pay it. So you're making payments every month until this money's paid off, right? The thing with that is your credit is still damaged for 3 years after. It'll stay on your credit report for 3 years after that 4-year period, and you paid all that money. What this lady should have done is just file bankruptcy, and in 9 months it's discharged, and she'd owe nothing. You get what I'm saying? So what she did though was she filed a consumer proposal, couldn't keep up with the payments, and now that's reported on her bureau, right? So it's worse than the bankruptcy. It's worse than even the consumer proposal. You'll see some collection items there, a number of collection items. And you'll even see 2 judgments. So these are people, this is worse than collections. These are companies who took her to court and got a court judgment against her, right? Then you'll see her actual trade lines now. So you'll see words like written off. I should use this pointer, right? You'll see words like written off, which means it's a bad debt. They couldn't collect on it, so they sent it off to a third-party collection agency. Again, so you'll see, assigned to third-party for collection. You'll see, so she's maxed out on a lot of her credit. So she's over the limit on this one. She had a $1,200 limit. Somehow she went to $2,612. Right. So we'll get into what some of these terms are. You'll see terms like R5 or O5, right? O5, R5. So R means revolving. That's typically credit cards or lines of credit. You can pay it down and then you can redraw on it again, right? R is revolving. I means installment. So an installment loan would be like a car loan. You pay it down every month until it reaches 0, right? O is open. So that's like a cell phone account. Again, those ones don't count as real trade lines when you're getting a mortgage, right? So I1, R1, O1, that's good credit, you're current, right? R2, I2, O2, 30 days late, right? So once you get up to O4 or O5, you're 5 and 6 months late, essentially, right? And then R9 means collections, they've written it off, bad debt. So you'll see some more of those.
May I ask something?
Yeah, sure.
What was the issue with this person? Because it looks like she had a good job. It looks like,
She actually makes over $100,000.
Right.
Right.
That's a good job.
How did you know she has a good job?
Because it said there she's a transit operator for the city of something.
Okay. Yeah. So
we look for these things.
yeah, she makes excellent money, but some of it, and I'm not a mental health expert, but I noticed certain things. She's not. She does have some mental health issues, right?
Oh.
But generally speaking, just really poor money management, right? I was able to help this lady. We refinanced her home because she had some equity, and we managed to pay off all this stuff, and immediately get her a new start because it wasn't a bankruptcy or a consumer proposal. So once it was all paid off, she could go out there and get a secured credit card, right? That's how people like this, once their debts are paid off, they can start rebuilding their credit, right? So you send $500 into Capital One, they send you out a $500 credit card, and hopefully, repay it. Your credit starts getting good again. They'll eventually send back your $500. You'll have a regular credit card, and rebuild from there, right? That's the plan. So this is another individual who has a worse score, 492. I don't think she has quite as many inquiries, but what you're going to see though is a lot of the lenders that she resorts to are what we call loan sharks in the industry, right? So City Financial, Prudent Financial, Easy Financial, Fairstone is the new name for City Financial. They're loan sharkish in that their interest rates are crazy high, and the collection actions that they take are very aggressive, right? And it's typically only people who already have bad credit that have to resort to these kinds of lenders, right? So, yeah, you'll see Prudent Financial. I don't know why she had so many Prudent loans, but again, that's an immediate red flag, right? And you'll see like that's her balance right there. That's her limit. So she's over the limit. That destroys her score. And she's pretty much maxed out there. If we scroll down some more, she's over her limit right there. So it's repeated behavior, right? This individual, you can see why she has a 492 score. So that's the end of her report. We'll get to some better ones.
What's a good credit score? What's considered good?
Anything above 700. So borderline scores are about 650 to 680-ish. Once you get over 700, you're good, right? It used to be, back in the day, you could buy a house with 5% down, best interest rate terms with 600, but no more. The standards are getting higher. You do need 680 at least now to really get the best terms. And even then they're nitpicking, right? So there are some lenders who want 720 and up. So this individual here, he has 894. You're not going to see a whole bunch of inquiries with this guy. You're not going to see him maxing out his limit or anything like that. So where are his inquiries? Are there any? Yeah, these are his inquiries here, 3 of them. So not very many, and that's in a 3-year span, so 1 a year, right? He's a retired individual. He actually didn't make a whole lot of money in terms of annual salary, but just very good at managing his funds. So you'll see right there, balance, 0, limit, 16K, right? Again, same thing. Balance, 0, limit, 10K, 21K limit, 0, 0, like, he's perfect. Same thing, 15K limit, 0 balance, all through. So, and again, none of the judgments or none of those prudent financial loans. Very good at managing his finances. Listen, go ahead.
Doesn't affect his credit that he has so many lines.
So, again, that's the perception, right? Not so much the score. If somebody sees that you have a whole bunch of credit trade lines that are open, they'll wonder what happens if you start running them up. But if you notice, not all of his were open, right? Some of them were old and closed, right? So like this one was closed in 2013. That's the date of last activity we're talking about, right? That it tracks you by. So this fellow has it 876, and you'll see some commonalities, right? He has 1 inquiry in 3 years. This fellow didn't have a very high income either, but you'll see he's very good at managing his funds as well, right? 0 balance, 22,000 limit. And his lenders, similarly, it's Scotiabank, it's Royal Bank, those kinds, and they're all zeroed out, right? All zeroed out. So that's it for the credit reports. Anybody have any questions?
Once again, you said perception versus
Credit score, right? So there are only so many things that the algorithms in the computing software can do to determine exactly how creditworthy you are, right? You actually need a human to interpret some of this stuff. I mentioned that this is the lender version that like the banks see, mortgage brokers see. When you pull your own credit, it looks different, right? So, for instance, we'll see whether, the fraud scan warning. If somebody tried to do something funny with their SIN number, we'd see that. It gives us some of the explanations as to why they like this person's credit, right? So it'll break down the types of credit that he has, whether it's open, revolving, installment, and it kind of gives you a breakdown. The consumer version is not that detailed. It's more colorful. It's more consumer friendly. You know what I mean? The other thing I should say though too is there are two credit reporting agencies in Canada. There's TransUnion and there's Equifax, right? Equifax, for all intents and purposes, is the main one. That's the one that the mortgage lenders use primarily, right? The other one, TransUnion, it's not quite as reliable, and that's just because not as many lenders use it, not as many people use it. So what they do though to try and catch up and get the people using it more is they offer it for free. So when you check your credit via Credit Karma, that's TransUnion. Some of the banks, if you download their app, will allow you to check your credit on there. That's TransUnion. So they're offering it for free so that more people will be updating. Because if you're not checking your credit, you're not updating it, right? And their information is outdated. So in the coming years, I suspect TransUnion is going to be catching up to Equifax in terms of reliability. But for now, Equifax is the gold standard. Anybody else? Go ahead.
I missed what you said about the first woman who said she should file for bankruptcy.
Had she filed for bankruptcy, right, she would have had a 9-month period where she would have had to make small payments, right, to the creditors based on how much money she has and how much she makes, right? But after 9 months, it gets discharged. So she'd owe no money, right? She wouldn't have been in that situation where she has to pay, maybe $1,000 a month for 4 years. And then a couple of years in, after paying all that money, she can't afford it anymore. And then she gets this judgment against her. Do you know what I mean?
How do you recover from a bankruptcy then? That's the fear, the B word.
So remembering that after 9 months, you can actually go out and start getting secured credit cards and build your credit up. So the bankruptcy stays on for 6 years, but after 9 months, you can start rebuilding. So that by the time the 6 years is up, you already have reestablished credit. You know what I mean? The proposal takes longer, and it takes a lot more money to get out of. Make sense?
So, sorry, you could get that secured credit card after 9 months?
After 9 months.
Perfect.
Yeah.
Okay.
Yeah. So Capital One offers them, Home Trust offers them, Refresh Financial, a few companies out there that offer.
That was kind of my question, because if somebody's filed for bankruptcy and now they're applying for a credit card, I would think that more established companies will not want to provide credit. It would be these loan shark type cases.
So it's not that they're necessarily loan sharks. They are making you secure the credit card. So you literally have to send in the amount of money that they're going to send you back on the credit card. So the difference between that and like a prepaid card is that prepaid cards don't report to Equifax, right? That's probably the main difference. But even the banks offer secured credit cards. So Scotiabank has a secured credit card, TD has it, right? Works the same way. You send in $1,000, they give you back $1,000 credit card. And that's how people who either have no credit at all or are recovering from a bankruptcy would reestablish.
Is a consumer proposal looked at differently by the lenders in a bankruptcy? So if you did complete a consumer proposal,
That's another thing.
actually look differently or not really? You wasted another 3 or 4 years of your life.
So they're looked at the same. The trouble with the proposal is while you're in it, the lender won't look at you at all, right? The bankruptcy, there's just that 9-month period where they won't look at you. Even though it's going to stay on for 6 years, they will look at you during that 6 years. Okay, so the question, was, does the lender look at a proposal differently versus a bankruptcy, right? And yeah, the answer is the bankruptcy, they'll look at you after the 9 months, right? Whereas the proposal, they'll only look at you after the 4 years or however many years it took for you to pay that off. Make sense?
If they see that you completed a proposal, it's the same to them as a bank.
Yeah. Once you're discharged from the proposal, whether it took you 3 years, 4 years, 5 years, it's looked at the same way as a bankruptcy. Yeah, sure. So the question was, if you had 2 credit cards, $5,000 each, and maybe one was maxed and the other one was empty, and you kept juggling money back and forth, right? Would that boost your credit? It only boosts your credit temporarily, right? After that after that creditor has reported to Equifax, right? So even the trick I told you about, it's a temporary thing for the mortgage broker to check your credit at the end of the month after you've zeroed out those accounts. Because the next month, right? Those reporting agencies are going to report to Equifax again, and it's going to show the reality, which is that you're maxed out. You get what I'm saying? It's only going to last for a certain period of time because each creditor reports every 30 days. And I know I might be confusing with that. Anybody need more clarity?
Like, meaning you still have balance, right?
You still have a balance, and the next time they report, it's going to show, right? So it's just a matter of getting a snapshot, because that's all it is. This is just a snapshot of your credit on the right date to make it look a certain way. Do you get what I'm saying? Yeah. It's not actually a way to improve your credit over time. It's just a way to boost it temporarily.
Boost it temporary for the purpose of like buying a home.
Yeah.
So
Yeah,
for
you just want
a
to look good
specific-
for that snapshot. You know what I mean? It's like posing for a picture.
Yeah.
You know what I mean?